Okay, so in summary, we've seen the volatility in the gas market shift from short-term cycles, which is one season or 1 year, to longer-term cycles, which suggests to customers that they should be looking at hedging longer term instead of shorter term. Some of that volatility includes the amount of storage. So we've seen the industry grow 40% since 2017, and we haven't seen that same corresponding increase in storage. And storage is a really nice asset to have because it smooths out the daily and monthly and seasonal usages for natural gas. With that being lower compared to the size of the industry, we're going to see more volatility. Speaking of volatility, we're going to see a lot of increases on the LNG demand side in the next 3 years. And it's the thought that by 2028, we could see our LNG capacity double in the US. And that creates some interesting scenarios, which is, we're going to see an increase in supply in the Gulf states, and we're going to see an increase in demand in the Gulf states. And it just so happens that the Henry Hub is located in one of those Gulf states. So we could see over time that the Henry Hub price in the US becomes more connected to global pricing, just like oil. And we could see specific basis points like the Appalachian Basin become somewhat disconnected from US Henry Hub prices, or that could widen in some cases. So also what we've seen is, last year it took producers quite a while to ramp up their operations due to, slow drilling and finding fracking crews and increased cost in all their materials. And what's interesting is that when we got to the low prices, we haven't necessarily seen a reduction in production, which we would typically expect to see with these lower prices. So what should happen in the future is, producers could become this, reluctant compliance with, hey, I've got to increase demand, or I've got to increase supply or decrease supply just based on the conditions are out there, which they don't seem willing to do right now.